the second one I'm posting, okay, that's the data we are going to use today, okay, and actually I would like to work on this with you to identify the determinants of stock return, okay, and I just find the money growth, okay, money stock, and this is the 1 year treasury bill rate, 3-month treasury bill rate, S&P 500 index, and this one, okay, this one is the money growth, okay, money stock, and this one is the commercial paper rate, okay. So please have them downloaded. Okay, so when you are studying stock returns, okay, what determinants do you think can explain the stock price, the stock return?
Profit.
Profit, company's profit. Okay, Patrick?
Exchange rate.
Oh, exchange rate. Okay, and
Money supply.
money supply. Tiffany, what do you think?
I haven't read the material. I just moved out yesterday. I'm just read.
Oh, okay. Okay, so I have shown you, okay, today I have shown you some factors that might explain for the stock return. Okay, so before that, I would like to show you the stock price model. Okay, how do we compute the price of a common stock? Okay, this is the 1 period valuation model. Okay, we know that if we invest in a company stock, okay, this company might reward the stockholders dividends every year, and that's the dividend, okay, paid at the end of year 1. Okay, and then because this is a 1 period valuation model, okay, and the sale price of the stock at the end of the first period, we call that P1. Okay. However, either the dividends or the sale price of the stock, they are the future cash flow. Okay, and we need to discount them. Okay, and then to compute the current price of the stock. Okay, so we use the rate of return (KE). Okay. So KE represents the required return on investment in equity. So this is a 1 period valuation model. Okay, so we just consider that the person just invests in the stock for 1 year. Okay, so during the 1 year, the investor receives dividends at the end of year 1. And then the investor sells the stock at the end of the first period, and the price he sells is at P1. Okay, so we just discount the dividend and the sale price of the stock at the end of year 1. Okay, we discount them by the rate, okay, KE, acquired return on investment in equity. Okay, that's the 1 period valuation model. But if we invest in a stock for more than 1 year, okay, and then the model can be extended to this way, okay. So for every year, okay, if we hold the stock for N year, okay, so for every year we receive the dividend, okay. So D1 represents the dividend at the end of year 1. Then at the end of year 2, receive dividend D2, okay. At the end of year N, we receive the dividend DN. Okay, so suppose that the discount rate is the same. Okay, so we use the rate of return KE, okay, to discount the future cash flow, the dividend. Okay, and also when we sell the stock at the end of N, okay, then then we receive PN. That's the sale price. Okay. Also, we need to discount it by the discount rate of KE. Okay. But if PN is very far in the future, it might not affect the current price of the stock. Okay. So we might just pay less attention to that. Okay. Then the generalized dividend valuation model becomes this way. Okay, so suppose that we hold the stock, okay, for a infinite period. Okay, so we can summarize, okay, summation the future cash flow, okay, of the dividend, and we also need to discount it by the rate of return KE, okay, from period 1 to infinity. Okay, so the price of the stock is determined only by the present value of the future dividend stream. Okay, so the model I present you is the Gordon-Worth model. It is a model used to calculate the intrinsic value of a stock based upon the present value of future dividends that grow at a constant rate. So the constant rate we assume, okay, it is KE. Okay, it never changes. Okay, it is a constant rate. And the model assumes that a company exists forever and pays dividends that increase at a constant rate, KE. So to estimate the value of a stock, the model takes the infinite series of dividends per share and discounts them back into the present using the required rate of return, which is the KE. Okay. And the result is a simple formula, which is based on mathematical properties of an infinite series of numbers growing at a constant rate, which is the rate of return. And in our model, we use KE. Okay, so I just summarized some possible factors that might explain for the cash price. Okay, the first term, we call that term spread. Okay, and what's that? Well, actually, that's the difference between the short-term government bill rate and the long-term government bill rate. Okay. According to Casel, in 1971, he thinks that investors require a higher return on a longer-term equity, as the price of this equity is highly sensitive to changes in the discount rate. Okay, and so a higher term premium compensates for shocks to the discount rate. Okay, so what he thinks is that if we hold the stock at a very longer time, okay, then due to some factor, okay, that might affect the interest rate. Okay, and the interest rate changes that will also increase the interest rate risk. Okay, so in order to attract investors to invest in longer term equity, then the issuers might just give them a higher rate of return. Okay, so the higher the longer term equity rate, okay, the longer the term of the maturity for the investors to hold, okay, then the higher rate, okay, then the issuer will compensate the investors. Okay, and then Fama and French in 1989, okay, they just conduct the research and they find that, okay, there is a positive relationship, okay. So the term spread, okay, which is the difference between the long-term equity rate and the short-term equity rate, okay, will have a higher rate of return, okay, on the stock. Okay, so Fama and French confirms the positive effect of term spread on equity returns. Okay, questions? Okay, so what he thinks is that, okay, so there is a long-term stock and short-term stock. Usually, investors will prefer holding the short-term stock. Okay, but in order for investors to hold the long-term stock, okay, then the issuer will pay a higher rate of return on the long-term stock. Okay, so it has a higher return. Okay, so the longer term of the stock, okay, the higher rate of the rate of return, okay, on the long-term stock. Okay, so the difference between the long-term and short-term interest rate. Okay, long-term interest rate minus short-term interest rate is called the term spread. So the term spread is the one of the factors that might affect the stock price. The second one is monetary policy. Okay, so remember from the generalized valuation of stock equity model, to calculate the current price of the stock is the summation of future dividend and discounted by the rate of return. And we assume that we hold it forever, and also the dividend actually just grows at a constant rate, KE. So we hold it from period 1 to infinity. So that's why the monetary policy might affect the current price of the stock, because whether the Federal Reserve conducts a easing policy or a tightening policy, that will affect the interest rate. And then the interest rate will also affect the rate of return. And then that will affect the current price of stock. So let's see what Fama and French thinks. Fama and French, Jensen and Johnson and Patelis, in their opinions, because stock markets are forward-looking, and they have future information content. So monetary policy determines investors' expectations about stock prices. And based upon Bonjourland and Latimer and Castelnuovo and Nistico and Gallian Gittler, stock market will also affect the expectations about the stock market performance. So not only they will affect investors' expectations about the stock prices, but also the stock market performance. So let's see. If now the central bank or the Federal Reserve conducts a tightening monetary policy, which means the interest rate will go up. So when interest rate goes up, of course, investors might require a higher rate of return. So KE will also go up. And because KE represents the discount rate, now the future cash flow of dividend, discounted by a higher rate of return, that will definitely reduce the current price of stock. So when the price of stock goes down, then the stock return will go down. Inversely, if now the Federal Reserve or central bank conducts an easing policy, an expansionary monetary policy, so they cut the rate, then investors might require a lower rate of return on stocks. Okay, then now we use a lower rate to discount the future cash flow of dividends. Okay, in this case, the current price of stock will go up, and then we will see an increase in the stock return. Okay, so this has been confirmed by Ioannidis and Kondonikos. Okay, in their research, okay, they found that the tightening monetary policy is associated with lower stock returns through higher discount rate and lower stream of future net cash flow. Okay, and about the easing monetary policy, according to Bernanke and Kuttner, okay, Bonfim, okay, Conover et al., Kuttner, and Poole and Rush, okay, and Thorbeck, okay, they think that an easing monetary policy leads to a higher stock return. Okay.
So can I ask you something like, if interest rate go down, so stock interest rate go down, and the requirement for profitability of stock will go down. Is there like a relationship between K, like profitability ratio, and like growth rate of the price? It's like if like require profitability go down and growth rate will go up.
Oh,
Good question.
Price.
Oh, you mean, okay, so in this case, I will say that, okay, when the price of stock go up, okay, what you are asking is about the firm's profitability, right? Okay, so of course, to firms in the stock market, they have seen an increasing in the stock price. Of course, to each of the firm, okay, they will see a higher profitability.
So price of the stock will rise.
Yes, yeah, and then we will see a higher profitability for each firm. Okay.
Because I read a paper a few years ago. There is a relationship between the payout, dividend payout, and the speed of growth for the stock price. Like if like the lesser the dividend payout, the faster the stock price grow.
Oh, yeah. Okay. For example, some companies, okay, just like what you mentioned, but that's not Apple. Apple is not the case. Apple never pays the dividend. But some company, okay, just like what you mentioned, they decide to pay less, okay, dividend in order to have a higher profitability. Yeah, some companies do that.
But not all companies like pays the dividends. Like when I try to buy some stock prices back in Indonesia, I was buying the stock of the Acer Group in Japan. It is a Japan company, but they like pay dividends every month. So if you said it's some company, that means that there are company that doesn't pay dividend.
Yeah, like Apple never pays dividends. Yeah, because they would like to have the money to do research and development. Yeah. Okay, and the next one is called market liquidity. Okay, so some investors would like to hold treasury bill. Okay, that's issued by the government, the treasury. Okay, yeah. So because government is the issuer, to most of us, we think that it is a secure securities. Okay, so as compared to the treasury bill, okay, how about the commercial paper? Commercial paper might consider to be a insecure securities. Okay, so in this case, we might not want to hold commercial paper. Okay, but in order for investors to hold the commercial paper, then the issuers of commercial paper might pay a higher rate of return. okay, to attract the investors. So according to Amihu and Bendelson, okay, 1986, the lower the market liquidity of assets, such as the commercial paper, okay, the higher their transaction costs. Okay, so if the security has a lower market liquidity, it means that okay, the time or the transaction cost, okay, for the asset to be converted into cash might take a longer time, or we might need to spend a lot of fees, okay, on the transaction. Okay, so these are considered as okay, lower market liquidity asset. Okay, so in order for investors to hold this lower market liquidity asset, then the issuer might just reward them a higher okay, rate of return. Okay, so that's this. So investors who hold assets with a lower market liquidity, they require a higher rate of return on these assets. So just like the spread. Okay, so I'm going to change this. So for the assets such as commercial paper, okay, that has a lower market liquidity. Which means that okay, when investors would like to convert okay, the commercial paper into money, into cash, okay, actually it takes time, and also the transaction cost is higher. Okay, so this asset is considered to be a lower market liquidity. Okay, so most people do not like to hold this okay, asset with particularly they have a lower market liquidity. But in order for investors to hold this, okay, actually the investors will like to require a higher rate of return. So the idea is this, okay. So the lower the commercial paper, okay, the lower the market liquidity, okay, for the commercial paper, the higher the rate of return on the commercial paper. And then we will see a increasing difference, okay, between the commercial paper rate and the treasury bill rate. Okay, so the difference between commercial paper rate and treasury bill rate is called the market liquidity premium. Because as compared to the commercial paper, okay, the treasury bill has a higher market liquidity. Okay, when we convert the treasury bill into cash, okay, or currency, okay, it takes less time, okay, and also the transaction cost is lower. Okay, so as compared to the treasury bill rate, okay, the commercial paper rate might be higher. Okay, and the difference between the commercial paper rate and treasury bill rate, we call that liquidity premium. Okay.
Isn't low liquidity assets also have higher risk?
Yeah. Okay, so according to Kara and Peterson in 2005, shocks to the market liquidity drives the asset's own liquidity and in turn asset return. Risk-averse investors hence require a higher return for holding assets with a larger market liquidity risk. Okay, so that just answered Charlie's question. Okay, so usually a asset actually with a lower market liquidity, it hence has a higher risk. Okay. And then Amihu again at all in 2012. Okay, they show that at a given cash flow, an asset with a greater market liquidity risk has a higher expected return. Okay. So the data we would like to use today, okay, the first one, okay, is the term spread. And the term spread is the difference between the short-term security rate and the long-term security rate. Okay, and we use the 3-month Treasury bill rate to represent the short-term security rate, and 12 months Treasury bill rate, okay, that represent the long-term security rate. Okay, so the difference between the 3-month Treasury bill yield and 12 months Treasury bond yield, okay, that represents the term spread, okay, which is the first factor. The second one is the growth rate of M2 stock. Okay, so in the U.S., M2 stock represents, okay, the broad definition of monetary aggregates. Okay, and the third one, okay, liquidity premium, and we use the difference between commercial paper rate and 3 months Treasury bill rate. Okay, as about the commercial paper rate, we also look at the same maturity, 3 months. Okay, so the above mentioned data source, okay, whether the 3 months Treasury bill rate, 12 months Treasury bill rate, okay, or the M2 stock, okay, or the 3 months commercial paper rate, okay, we can obtain that from the St. Louis Fed. Okay, and then let's take a look at the data.
Yeah. I'm trying to access the internet.
Have you done that?
I was not able to download it because I cannot access the internet.
Oh, you can do it when using mine.
It will not because I downloaded the software yesterday, but it's affecting. I need to
We need to
uninstall
clean the
this.
data
Oh,
first.
infuse.
Mm-hmm.
No, not e-views. This is for my work.
Oh, okay.
I need to remove it.
So the same as be fine with last time.
Okay, the first one, okay, you see DTB 1 year, okay, that's the 12 months, okay, 1 year Treasury bill rate, okay, and it's daily data, okay, it is daily data, okay, and 4.52, okay, the unit is percentage, okay, so July 15, 1959, okay, the 1 year Treasury bill rate is 4.52%. Okay. And the data starts from 1959 okay, to April 5th, 2021.
Does it work?
It's coming up.
And then the 3 months commercial paper, okay, the file name is DCPF3M. Okay, so that's the commercial paper rate. Okay, the maturity date is 3 months. And the data starts from 1997, January 2nd. Okay. And the last date is April 5th, 2021. Okay. And the third one, okay, the file's name is DTB3. This is the daily Treasury bill rate. The maturity date is 3 months. Okay. And the observation date starts from 1954. And the last observation is 2021, April 5th. And then the S&P 500 index. Okay. And the observation date starts from April 7th, 2011 to yesterday. Yeah, I'm sorry, 2 days ago. Okay, April 6th, 2021. Okay, and the last one is the M2 stock. Okay, so for the M2 stock, I just downloaded the weekly data. Okay, because usually the monetary aggregates, okay, are recorded by monthly basis. But from the St. Louis Fed, okay, we can obtain the weekly data. Okay, so except the M2, the other one, okay, the interest rates or the stock price, okay, they are on daily basis. Okay, so we can use the eViews to convert the daily data into weekly data.
So we work with the DTB3, the DTB 1 year and S&P 500, only 3.
Oh,
Data set.
and also the S&P 500.
Yeah.
Mm.
So 3.
Okay, hold on. DTB 1 year and DTB 3M and DCPF 3M.
Okay.
And then WM2NS.
Okay, so all of them.
Okay, the 5 of them. 5 of them.
Okay, so time frame is 1 day or 1 month.
Oh, 1 week.
Okay.
Yeah. Okay. Okay, so let me show you how to convert the daily data into weekly.
So we should clean up that first.
Oh yeah. Okay. Let's go to the S&P 500. As you can see that there are some missing values. Okay, so what we can do is we just write the data into eViews. Okay, so from File, Open, Foreign Data as Work File. Okay, and because all the data, okay, I just save it in the desktop. Okay, so I go to desktop, okay, and the file, okay, today's file name, 2021, okay, April 8th. Okay, so I choose S&P 500. Okay, so I can now read all the data into eViews. Finish. Okay, and then go to the file. Okay, and then you will see the series of S&P 500. Okay, let's click that, open it, and then view. Okay, descriptive stats and tests. Okay, let's use the stats table. Okay, so actually there are several ways to replace the missing value, but we can just use the mean to replace the missing value, or we can use the median rate. Okay, so let's just use the mean. Okay, so the mean is 2237. .241. Okay, let's remember this value. Okay, and then go back to the S&P 500. Okay, here. Okay, so we need to find the missing value first. Okay, file and then replace the missing value with 2237.241. Okay. There is an easier way. Okay, so go to the data, okay, and then sort, okay, and then I will choose NA. Okay, it means that there is a missing value. Okay. Wow, there are a lot of missing value. Okay, so and then I just filled out. Okay, the missing value was 2237.241. Okay, so I have finished, okay, replacing the missing value with the mean. Okay, so now we have a cleaner, okay, series for S&P 500. Okay. Any questions? Tiffany, are you okay? Would you like to use my desktop
No,
computer? Okay.
That will be recorded,
Oh, okay.
so you can just replay it.
Okay.
Yeah.
Go to the announcement. Or we can just go to discussion forum. Oh, sorry, announcements.
Very slow today.
Oh, okay.
I downloaded the software yesterday, so
Uh-huh.
it's really,
Oh,
this one.
today's exercise materials.
Need to remove this.
Oh, that's test gen.
Yeah, for my students.
For your student.
Yeah.
Are you teaching at the college?
No, high school.
Oh,
at
that's
that.
cool. Oh, so they are using a test gen.
Yeah,
Mhm.
I use it to generate this and then since then my computer becomes slow.
Anyway, we need to download
Download
all of
this,
them. All
They're
of them.
50.
Yes.
Còn đang cái S&P thay vô nó đang làm cái này.
Why is that?
Yeah.
Let's go back to. Have you? Yeah.
I haven't yet.
Okay. That's going to.
No, I need to like get the average number first, right?
Yeah, the average number is 2237.241.
Okay. Choose
2237.241. Okay, so while you are working on that, okay, let's go to the file, okay, for M2. Well, as you can see that the earliest date for S&P 500 is April 7th, okay, 2011. Okay. But for the other series, okay, their earliest observation, okay, actually we can trace back to 1954. But in order to have a constant, okay, time series range, okay, we might need to cut some previous observations. Okay, so let's try to start from 2011, okay, April 7. Okay, but before that, we need to check the M2. Okay, because M2 is weekly data. Okay, so let's scroll down to 2011. Okay, so when we scroll down to 1590, okay, the 1590 is observation. Okay, the closest weekly date, okay, which can correspond to the S&P 500, okay, is the 2011, okay, April 11th. So here comes the question. After we convert all the daily data into weekly, okay, we need to have a consistent time series frame, okay. But for M2, okay, because that's weekly, so I'm afraid that for all the data, the other data series, okay, our first observation might be stick to 2011, April 11th. Okay, so what do we do? Okay, we can ask eView to do that for us. Okay, so now let me show you. Okay, so after you clean the S&P 500, okay, we have replaced all the missing value with 2237.241. Okay, so now let's read the data, okay, to the eViews again. Okay, so from the eViews, okay, let's click New Page. Okay, and then let's click Load or Import Work File Page. Okay, did you see that? Okay, again, let's click New Page and Load, Import Work File Page. Okay, and then let's import the S&P 500. Okay, here we show all files. Okay. Okay, so this is the series for S&P 500 after we have replaced the missing value with the 2237.241. Okay, so our job right now is to convert the daily data, okay, to weekly, and the first observation should be, okay, April 11th, 2011.
Weekly 5 day.
Yeah, 5 day. Okay, so let's go to the new page. Okay, click that, and then specify by frequency. Okay. Okay, and then for the day specification frequency, okay, we choose weekly. But okay, the start date, okay, as I just showed you before, because for the M2, okay, for the M2 is on weekly basis, and the first observation for M2 is April 11th, 2011. So okay, when we convert S&P 500, okay, from daily to weekly, okay, the start date we choose April 11, 2011. Okay, and then click OK. Okay, and then we go back to the file, okay, and okay, we go to S&P 500 and right-click, copy. And then we go to the one we just specify the frequency, okay, and right-click, paste spatial. Okay, and the pattern will have a star, okay, behind. We paste as link, Okay, and merge by date with frequency conversion. Okay. Okay, so after conversion, okay, the S&P 500 is now on weekly basis. And the first observation is April 11th, 2011. Are you okay?
Okay.
Patrick, are you okay?
Yeah, I'm okay. What I'm working on my computer as well. I'm trying to uninstall this.
Oh, you need to,
Yeah, if not, the computer gonna work properly as well.
Oh, it's gonna take a while, Professor.
It's okay.
It's okay.
Yeah, because
Or,
We already have the recorders.
Yeah.
I forgot to bring my laptop.
it's okay. Or you can use the desktop.
No, it's okay.
Are you
I'll do it.
okay?
Yeah,
Yeah.
yeah. We're fine. Is it like not enough RAM or something?
Are you okay?
I think so because it was not behaving like this. The hard that I downloaded, installed something yesterday.
Check the task manager. May I?
Okay. After conversion, let's just copy the series for the weekly S&P 500 to a new Excel file.
So that you can end the unimportant.
Okay.
Sorry, can you make it a bit light?
And let's give the series a name, which is the S&P 500.
Oh, you don't have the framework, that's why.
I was using the MacBook. It's because of this email, that's why I started to bring this. For this long time I never used.
Okay, and then let's
Framework is not
okay
in
just
system.
work on the M2. Okay, so M2 we need to cut the observation date before 2011 April 11. Okay, so let's clean
What makes
the previous
your computer
data.
not working? It takes a lot of error. So you can just end this.
I'm going to from the charger. I'm going to give it a moment.
Okay, after we clean, okay, we just cut the observations before 2011 April 11.
Why did we need to like
This.
April 11? Because MP5 is April 7.
Oh, yeah, because as you can see the M2, okay, from the M2 series, the
M2 is 1980.
oh yeah, but for S&P 500, okay, S&P and 500 that's 2011 April 4th, right? April 7th, yeah. So in order to, yeah, because we need to convert this into weekly, and then M2 is on weekly basis, and the earliest date is April 11th.
So this day wait Monday
Probably I will.
because this
You want to
is
decide
Monday.
this?
So we give Monday.
Yeah, Monday by Monday, Monday by Monday. Yes, yeah. We need to have a consistent frequency.
How did you get Monday? Did you look at the calendar or something?
No, just look at the observation for M2.
What makes it working slow is the Microsoft Google Chrome. And I've already ended this, so it should be better.
And then let's move up there.
This one?
No, this one. So I don't log in.
Are you okay?
Yeah, I'm trying to fix his computer.
Oh. So did you install the test gen?
I will install it, yeah.
Oh, so now you need to install the eViews?
EViews are already installed.
Oh.
Click here.
Oh,
Where does it? his computer is working on 100%. So the random access memory is all used. So that's why he can access anything.
Oh.
It's all full.
Oh.
So he gotta clean up first
Uh-huh.
before he opens it.
Oh.
She's the new computer expert.
Yeah, yeah,
How much do I
good.
need to pay?
So did you study computer science?
I was working as a digital marketer before I studied here. So I get used to
So you
it.
are good with computer.
Just a little bit.
Okay, after we clean the N2, let's copy the series to the new Excel file. Okay, the one that I have copied, that I have pasted the SMP file.
You can look now. It works better.
Yes, so.
Can we copy directly on the eView file instead of copy from Excel file to Excel file?
I haven't.
Yeah, you can do that.
So we can like copy all in one like predetermined eView file, then we can export at one instead of do one by one by one by one.
Yeah, you can do that.
That will save you time.
Yeah.
And we can check the number of observations too. which
Oh,
we
good.
Need.
Okay, so in the new Excel file, we already have SMP 500 and M2. Okay, so now let's work on the other three. Do you need to take a break? Oh, I'll take a break. Okay, let's take a break.
Tiffany, do you want to go meet in April
To what?
to say hello?
Okay. Tell me if your computer is slowing down again. I'll fix it.
Okay.
Excel to find the average, to compute the average for commercial paper. So here, let's go to the blank. Okay, type equal average. Okay, and I start from F2, which is the first observation, to F518.
518.
Okay.
Okay.
And then the average is 0.7698. Okay. And then I just sort the commercial paper rate, the column. Okay, I choose the space.
By the way, I'm very fast. I'm lost.
Oh, okay, let me help you.
Yeah,
Don't worry.
after-
Okay, let me help you.
After average.
Oh, okay.
From where?
F2 is the first one. And yeah, and then F2. Okay, let me do some. Okay, because for this is M2, the last observation is March 1st. Okay, but for the other one, yeah, for the other one, actually they have April 5th. Okay, so let's just delete all the observation, delete. Okay, and here, okay. This is the commercial rate, equal average. Okay, let's start from F2. F2 is the first observation. To
So what is the problem? What is the problem? What do we
Missing values.
missing value?
Here from commercial paper and
How many observations do we have?
I remember 5 or 6.
Six.
Oh, 6. Yeah.
How I
Okay,
will
so
not like
we use
525.
0.7698. Okay. So here,
home.
data, oh, filter. Yeah. Unselect all. Okay, let's find the blanks. Okay, and then I fill that the missing value with 76.28. We'll go and then go back to data, no filter.
Okay.
So all observations are they are clean. Oh, yeah, don't forget I read you.
Remove this. Pencil. Thank you. You understand?
Okay. Do you need me to upload this clean file to iLearning? Do you need me to do that?
Yes.
Yes,
please.
Okay.
You know I have it. I need to close it and do it again because the file we uploaded first.
Yeah.
Let's use the new file.
Okay.
New file.
I'll post it. Okay. Then let's go to eViews, open a new page,
Okay.
and then load. Okay, now let's load the weekly file. Okay, the one that I have cleaned up all the missing values, and I have converted all the daily data into weekly data. Okay. Load import work file page. Okay. It is in the desktop. Okay. 2021 April 8th. Okay. All files. Okay, and the name is all. Okay, sorry. Okay, let me fix something. Have I missed anything?
We have to shift.
Oh, sorry. Sorry, let me do one more thing. Okay. The one I just sent you out, okay, that's okay, I only paste 2 series. Sorry, let me do that again. Sorry. So yeah, you can go to the announcement and then download the file. Oh, okay. This is the worksheet that I have cleaned up all the missing values, and all the series are on weekly basis.
And then combine to weekly data.
Uh-huh.
Oh, yeah.
Okay. And then let's go to eViews. Okay, new page, load, import work file page. Okay, desktop. Okay. Let's go to the file, 2021 April 8. Okay, all files, all. Okay, next, finish. Okay, so for the, okay, let's see. In this sheet, there are 1, 2, 3, 4, 5 series. Okay, the first one is 1 year treasury bill rate. Okay, the second one is 3 months commercial paper rate. The third one is 3 months treasury bill rate. Okay, this is constant term. M2 aggregates. Okay, residual. Okay, series 1. Okay, actually you don't need to worry about that. It just gives you the observation date. Okay, and last one is S&P 500 index. so let's do something. The VRR1, I would like to include the first variable is the stock return. So I'm going to generate a series called stock return. And then the second one is term spread. The third one is called M2 growth rate. And the last one is called liquidity premium. Okay, so these four are the series that I'm going to generate, in eViews. Okay, so let me start with stock return. So let's go to object, generate series. Are you with me? Oh, Charlie, are you okay? Do you need help?
Give me 2 seconds to.
Oh, no problem. Patrick, are you okay?
Yeah.
I'm recording.
Oh, okay.
Right.
Can you see that?
Yes.
Why I cannot open this file in view?
Oh, the O.
Yeah. You know.
Oh, I see, because when we are using eViews, actually, whenever we open eViews in Excel, the computer might think that we always open the Excel through eViews, but actually we are not.
Professor, I have different version of eView on my on my laptop. I was using the eView 11.
Oh.
So that when I was submitted the previous assignment, I can't click the C. So the C data is not.
It's constant.
It can't be seen. So that's why I have a different result.
Okay. No worry. Actually, C does not affect your results, right? C doesn't matter.
Doesn't matter. But I had different results.
Oh, you have different results.
Yeah, on the previous assignment. I thought that was because of the different version of the eViews, or I did math mistakes. Because I was still in quarantine, so I don't know who to ask.
So if you
I'm trying
you
to.
need help,
Yes,
yeah.
to load the new key from. Who is it? It's empty.
Just O.
Oh,
Yeah,
from it.
all files.
Oh.
Yeah, O.
You use Android, right?
What?
You use Android phone, right?
Yeah, next.
What?
Android.
Finish.
Your phone.
Yeah. So
You
now,
you
okay.
we type C.
No worries. So now let's
No.
use this to generate the 4 series.
No, it's not the types yet.
Okay, so to generate the stock return, here, in the generate series by equation, let's give the S&P 500 return a name. Let's just call it SP 500 return.
How do you get the small box inside?
Oh, okay.
On generate,
Okay.
right?
Okay, again, object,
Generate
Object.
series.
generate series.
There will be a box
Okay.
And then in the box,
with the same
let's say SP 500 return.
SP 500.
okay, equals log, L-O-G, okay, parenthesis. Okay, so the first time we just insert SP500 and divided by the previous observation of SP500. And another parenthesis, okay. After that, you multiply by 100. Are you okay? Can you see that clearly?
No.
Okay. Oh, sorry. Let me write it down on the blackboard.
Okay.
So inside the box, you type. Okay, can you see that?
Yes.
SP500
Yeah, SP500 return.
equals log.
Yeah,
No space?
no space. Log. Okay. And inside the parenthesis, okay. The first time you insert SP500, it means the current term, okay, of SP500 index divided by the previous observation of SP500. Okay, the previous we use, okay, so after you type SP500, a parenthesis, and inside the parenthesis you put -1. Okay, and don't forget, there is another parenthesis.
Can you run that? Can you run that? I want to see the return value.
Oh, okay. And after that, you multiply it by 100. And then you will be-
multiply by 100?
Yes, and then it will be a return, rate of return, okay?
We
Okay.
put the multiple of 100 inside the box.
Oh,
Oh,
a bit, oh. Let me check, okay. Okay, and then, multiply by 100, okay? And then, okay, so the return is here. Now let's click OK. And then the eViews has generated the S&P 500 return series for you. Okay, so we have done the stock return. Now, let's see the second series we'd like to generate is term spread. Okay, term spread by definition is the difference between 1 year treasury bill rate, okay, and 3-month treasury bill rate. Okay. So let's go out, okay, and go to object, general series. Okay. Okay, the name for the series, let's just call it term spread. Okay, equals. Okay, don't forget it has an underscore. Okay, underscore 1 YTB. Okay, so this is the 1 year treasury bill rate. Okay, minus underscore okay, 3 NTB.
NTB.
Yeah. Okay, and then okay. Okay, so now another series has been generated. It is called term spread.
sorry.
Yeah.
I thought you were going to write because
Oh.
I can't see.
Oh, okay.
Yeah, just write it out.
Okay,
Plug
okay.
it in and then.
So inside the box, we generate another series called spread.
Is it equals to?
Okay,
Underscore.
equals underscore 1 YTB minus underscore 3 MTB. Okay, it means
Click OK.
we would like to find the difference between 1 year treasury bill rate and 3 months treasury bill rate.
TB and then you click OK.
Okay.
Okay.
Yeah, please. This one is already open here.
I can do it. Open the transfer.
Maximize. Yeah, this is SP.
Okay.
You
Okay.
do the one.
Now, let's see, another series we'd like to generate is M2 growth rate. Okay, so again, let's go to object, generate series. Okay, let's call that M2 growth rate. Is the name too long? Or we just call M2 rate?
M2
Got right.
M2 rate.
Okay, M2 rate equals log
equals log
parenthesis okay,
versus
Open.
M2
M2
over M2 parenthesis -1. Okay, another parenthesis multiplied by 100. Okay, let me write it down. Okay, so the M2 rate
like this, can you see?
equals log
Look at my phone screen.
M2 over the previous observation of M2.
She's writing it down.
Okay. After that, multiply it by 100. Then click OK. Okay.
Could you open the M2? Yeah. Okay.
Okay, so this is the M2 rate.
Yeah, super right.
Now let's generate the last term, liquidity premium. So by definition, liquidity premium is the difference between the 3 months commercial rate and the 3 months treasury bill rate. Okay. So,
So S&P minus
yeah,
S&P minus
an object
1 TB.
is 3 MTB.
Okay.
Okay, so let's call that
Premium.
the premium. Okay, premium equals okay underscore 3M CP okay minus underscore 3M TB. Okay, then okay. Premium. So Patrick, are you okay?
Yeah. $3 minus underscore 3
Yeah, commercial rate, commercial paper rate minus treasury bill rate. Okay, so premium equals underscore 3M CP. Okay, that's the 3 months commercial paper rate minus underscore 3M TB. Okay, the 3 months treasury bill rate.
Okay. Just that?
Mhm.
And then you could go.
Yeah, so now we have generated 4 series. Okay, so after that, we would like to have a vector autoregression model. Okay. So vector autoregression model is a very good model if you do not know which variable is the determinant, or which variable is the determinant variable. The other one might be the explanatory variable. So which one is dependent variable, which one is independent variable. Okay, we can use the vector autoregression. Okay, but before that, we need to check stationarity. Okay, so we use the Uniroot test. Okay, so let's first check the S&P 500 return. Okay, let's open that and view the Uniroot test. Okay, we would like to check in level whether it is stationary. Okay, let's check the trend and intercept in level. And the lag length, we use the Shirowa's information criterion. Okay. And the maximum lag length, we use 18. Okay.
We use trend and intercept.
Yeah,
Okay.
yeah, trend and intercept.
Okay.
Check. Okay, so the table result tells you that the augmented Dickey-Fuller test statistic, the t-stat is minus 18.2233. The p-value is very small. Smaller than 0.05 or 0.01. So it is significant. It means it passed the unit test. So the series of S&P 500 return is stationary.
How do I save this?
Few.
I've generated already. I want to.
Oh, yeah. So according to the test statistic, it is minus 18.2233. And the test critical values, tells you that it is smaller than any of them. The p-value, the probability tells you that it is very significant because it is lower than 0.05 or 0.01. So it is significant. Yeah, it passes the unit test, so it is stationary
Yes, I
in
want
level.
to save it.
Oh, you want to save it? Okay, freeze. And then give it a name. That's table 1. Okay, your turn. So, stock return is stationary in level. Sorry, it's my characteristic very small. Can you see that clearly?
Yes.
Okay, Patrick just asked if we can save the table results. We can do that. We choose freeze, and give it a name. Table 1. Then let's check term spread. So term spread, we double click, view, unit test. Again, we choose augmented Dickey-Fuller test for unit in level, including the test equation, trend, and intercept. The lag length, we choose the Shirowa's information criterion. Maximum lag is 18. So in this case, unfortunately, the test statistic is very large. It is negative 1.6175. As you can see that it is larger than any of the test critical values, so it is not significant. It does not pass the unit test. So maybe we need to check. If we should first difference that. So we go to view again. Unit test. Now we choose the first difference. And still we include the trend and intercept. The lag length. We choose the Shirowa's information criterion, 18 lags. So after we take the first difference, the term spread, with first difference is stationary, because the test statistic is smaller than the critical values, and the p-value tells us that it passes the unit test, so it is stationary in first difference. So if it is stationary in first difference, then for the term spread, we need to generate another series. That's the term spread after you take the first difference. So let's go to here. That we need to generate the term spread with first difference. So let's call that D term spread okay, equals okay, D okay, and parenthesis. And inside the parenthesis, it is term spread.
So not like this.
Okay, so Patrick, are you okay?
My eyes
Oh,
are disappointing me. You said inside the box.
oh, Charlie, are you okay?
Working on it.
Oh, so let me help with Patrick.
Yes.
Okay,
What is the name of the file?
okay, D term spread. Okay, because from the unit test, okay, it is stationary after we take the first
First difference,
difference. Yeah, so we need to generate the series. It means it is after first difference.
Difference.
Yeah, so equals D parenthesis. And inside parenthesis, you have term spread.
And then you click OK.
Yeah. So that's the term spread after first difference. Charlie, are you okay? Okay, then M2 growth rate. Okay, let's go to M2 rate view, unit test. Okay, let's check level and trend and intercept are included. And the selection is Schwarz information criterion, maximum lag 18. Okay, so from the test statistic, it is significant. It is lower than 0.01. So M2 rate is stationary in level. So we do not need to take first difference of that. Okay, then let's see the last term, okay, premium. Okay, view, unit test. Okay. Test for level, trend, and intercept are included. Okay, Schwarz information criterion, maximum lag 18. Okay, and the test statistic is minus 8.98. It is significant. Okay, so it passes the unit test. So it is stationary in level. Okay, so now we have the stock return, M2 growth rate, and liquidity premium. They are stationary in level. Okay, the term spread, okay, after we take the first difference, okay, it is stationary. So let's choose the variables. Okay, the first one is the S&P 500. And then the second one is D term spread. The third one is M2 rate. The last one is liquidity premium. We choose these four series. Okay. Are you okay?
No,
Oh.
we start with which one?
Oh,
The
The-
SP
the term
500
spread,
return,
right?
premium, M2 rate, and the term spread.
D2
okay,
and
the
2
first
right.
one is stock return, and you click T control. Then the second one is D term spread. Okay, the third one is M2 rate. The fourth one is premium. Okay, so now we have chosen the four, and then right click, open a VAR. Okay, so okay, so
We'll explain it.
oh yeah.
Open them up. VAR.
Yeah, so let's right click, open VAR. Okay, and we use the unrestricted VAR. All of them are endogenous variables. Okay, the lag length, actually we have no idea yet, just use 2 lags. Okay, and then exogenous variable is C. Okay, but we have no idea about the lag length, so we go to view. Okay, choose lag length. Okay, and then lag length criteria. Okay. And the last two include, let's just use 8. Okay. Okay. So it depends which criteria you would like to use. Well, we have used the Schroer's criterion, information criterion, to choose the lag length for unit root test. So maybe we can use that, okay, to choose the lag length for VAR. Okay, so it depends upon you, okay, which one you would like to use. If I choose to use the Schroer's information criteria, okay, then from the results, it tells me that I should use 4 lags. Okay. If you choose AIC, then you choose 6. Okay. For HQ, 6. For FPE, 6. For LR, that's 8. Okay. So which one would you like to use?
Can you explain that again?
Oh.
Okay.
Okay. Are you not here?
Yeah, I'm there.
Okay. But whenever we count VAR, okay, we need to determine the lag length, okay, for each of the variable inside the VAR, okay, framework. Okay, so we go to here, and then it just provides us the results, okay, for the lag length. So there are 5 criteria, okay. So each of the criteria, okay, gives us different lag lengths. Okay, so if I choose Schroer's information criteria, okay, it tells me I should use 4 lags. Okay, if I choose AIC,
Oh, okay, the one with the asterisks.
yeah, we need to use 6 lags. Okay, if I choose HQ, 6 lags.
Yeah, I understand now.
So how about we just use the Schroer's information criteria?
Yes, maybe later we compare.
Oh yeah, we can compare. Yeah. Okay, so between 4 or 6. Okay. So let's use 4 first. So go back to estimate. Because the original one, we just used 2 lags. But now, according to the SC, we should choose 4 lags. So you type 1 to 4. What it means is that, okay, you include, okay, lag 1, lag 2, lag 3, and lag 4. Okay, and then click OK. So you see, there are 4 columns. Okay, when S&P 500 return is the dependent variable. Okay, and the S&P 500 return for lag 1, lag 2, lag 3, and lag 4. Okay, those 4 represents the independent variable for the stock return. Okay, current stock return. Okay, and the term spread, okay, which is the growth rate of term spread, lag 1, lag 2, lag 3, lag 4, okay, they are also serving as the determinants for S&P 500 return, okay, and the same for M2 rate, lag 1, lag 2, lag 3, lag 4, okay. So how do we interpret lag 1, lag 2, lag 3, lag 4? Because this is a weekly basis data, okay, so it means, okay, the last week's return, okay, actually when it increases, the current stock return will increase by 0.2342%. Okay, is this significant? Well, according to the results, the first one, the first variable, okay, the value represents the slope coefficient. Okay, inside the parenthesis, this is the standard error. Okay, and the 1 in the bracket stands for the t-test statistic. Okay, so usually, okay, if we use the test statistic, okay, we need to remember 3 values. Okay, if it is 10% significant, then the t-test statistic should be positive or negative 1.6 45. Okay, that's 10% significant. Okay, if it is 5% significant, I'm sorry, can you see that? Can you see that? Or should I scroll up? Okay, so 10% significance, the T-stat is positive or negative 1.645. Okay, if it is 5% significant, then the T-stat is positive or negative 1.96. 1% significant, the T-stat is positive or negative 2.56. Okay, so go back to your VAR results. Okay, let's just focus on the first column because we would like to determine, would like to identify, okay, whether the previous stock return or the difference in term spread or the monetary growth or the liquidity premium can serve as the determinant for the stock return. Okay, so let's just focus on the first column.
Watch it over here later.
I can watch it now if I record it in my phone.
Okay, so let's just focus on the first column. Okay, so when the stock return serve as the dependent variable, okay, so the stock return 1 week ago, okay, it is significant according to the T-stat inside the bracket, it is significant. So when the previous week's stock return goes up by 1%, okay, that will contribute to an increase in the current stock return by 0.2342%, and it is significant. Okay, how about the term spread? Term spread. Well, the term spread 1 week ago, okay, as it increases, okay, it contributes to a negative 10%, 0.1061. Is it significant? Yeah, it is significant. Okay, how about the term spread 2 weeks ago? Yeah, it contributes to a positive effect. Okay, so when it increases by 1%, the current stock return increases by 5%, and it is significant. Okay, and then let's see M2 rate. Is it significant? Well, 1 week ago, it is not significant because the T-stat, okay, is, well, the T-stat is only minus 0.3983. Okay, it does not reach the 10% critical value. Okay, how about 2 weeks ago's monetary growth rate? Yeah, it is significant. The T-stat right now is 1.89. Okay, so it tells us that if the M2 rate 2 weeks ago increases by 1%, okay, then the stock return will increase by 0.27%. Okay, and then 3 weeks ago, when the money growth rate increases, well, it does not bring any significant effect on the stock return. How about 4 weeks ago? According to the T-test statistic, 1.689. So yeah, it is significant at 10%. Okay, so when the money growth rate increases, the stock return will increase by 0.25%. Okay, let's see the last factor, premium. Okay, liquidity premium. Okay, are they significant according to the value reported in the bracket, the test statistic? None of them. Okay, none of them are significant. Okay. So for your homework, I would like for you to just report the first column. Okay. Yeah, that's the first column. Okay. Yeah, because
For this one?
yeah, for this one. And then I would like for you to put some explanation. Yeah. On this. Because we have found that the market liquidity premium is not significant, okay, to the stock return. But the M2 growth, okay, the term spread after we take the first difference, and the previous stock return, okay, all of them, okay, they have explanatory power for the current stock return. Okay, so yeah, how about I will have you to report the results and put some explanations. Okay.
Sunday night.
Yeah, Sunday night. Can you do that? Do you have enough time?
Yes.
Okay. Okay, the R square is 0.1348. Okay, and adjusted R square is 0.10. Okay, not bad. Even though only 10%. Okay, but not bad. It's okay. Okay.